Project Treasure Island Part 2, Building Levers to Improve Our Stock Investment Strategies. Next. So our research group started this year by investigating how to build better stock investment strategies. In January, 15 student researchers each designed 3 different investment strategies using simulated buying from 2014 to 2023. We tracked returns and risks for each strategy, analyzing the results in February to identify areas for improvement. Since March, we've been working in separate project groups to develop materials to share our findings. These 2 groups are market prediction and sentiment analysis. Ideally, this will culminate in a publication about market prediction this summer. Next. So, our group student researchers selected 10 stocks. These stocks are a mix of high performing and volatile stocks, with some less volatile options mixed in as well. The long-term goal is to invest in broad tech index funds like NASDAQ or S&P 500. Currently, our code isn't efficient enough to handle the large number of stocks in an index fund. Next. So, risk is determined by the standard deviation of the annual percent return from 2014 to 2023, which is ideally low, while return, which is annual percent return from 2014 to 2023, is ideally high. Next. So this graph shows the relationship between risk and return of investment strategies designed by our group's researchers. Each data point represents a different student designed strategy. The trend line shows a mostly linear relationship between risk and return. This means that on average, higher risk strategies tend to have higher returns, and lower risk strategies tend to have lower returns. The key takeaway of this is that investors should be aware of the risk-return trade-off. In general, higher risk investments offer the potential for higher returns, but also come with the potential for greater loss. Next. So we studied 4 levers to improve investment strategies. These 4 levers are the diligence effect, diversification of investment portfolio, optimized strategies with market prediction, and leveraging the sentiment signals extracted from social media. Next.
Hi, I'm Pranav, and I worked on the diligence effect. And the diligence effect is examining the question, will increasing the frequency of reinvesting our money increase the return of the investment? Next slide. So what is the diligence effect and why examine it? So like I said earlier, the diligence effect is when we invest more and more frequently in a given time period. So let's say I invest once at the beginning of the year and then see the returns at the end of the year. I can be more frequent with my investments and check every 2 months, every day even. And this is an intuitive approach to investing. A lot of people do this actually. This is people rationalize this with keeping up with the market, which is where they believe if they can be more frequent with their investments, they can react to the market quicker and therefore have a better return on their investment. Next slide. So how can we investigate the diligence effect? We can analyze its returns given 3 different strategies of reinvesting cash. The first strategy is what we call high risk because it reinvests based on the standard deviation of the stock over the previous period, meaning the most amount of money gets allocated to the stock with the greatest volatility. Our low risk strategy is a reciprocal of the standard deviation, basically the opposite of the high risk strategy. So it's allocating money to allocating the most money to the stocks that have least volatility. And the dynamically allocated strategy, our third strategy, reinvests based on the return of a stock over the previous period. This is an intuitive way to reinvest. This is what a lot of people do. They look, hey, this certain stock did really good this last month. Let me put more money towards it for next month. And using these 3 strategies, we can apply that to the diligence effect and see how the diligence effect gives us greater or less returns for these three strategies. Next slide. So as you can see here, the diligence effect was ran, and this is from the beginning to end of 2023. Keep in mind, not from 2014 to 2023. As the processing times for that got a lot larger as you tried to get more and more detailed graphs. So there is one limitation to this graph. However, it does tell us a pretty nice insight into the diligence effect. As you can see here, all three of our strategies ended up producing a profit. They went from generally like $1,500, $2,000 to about $3,500 for the highest one, or above 3,500 for the highest one, 3,000 and then 1,500 for the lowest respectively. And this is really promising since we can see that the more we invest, so as you can see, going from yearly to daily reinvestment, we get greater returns. But this is applied only to the 10 tech stocks we discussed in the beginning, which are stocks that performed well and stocks that are volatile. So let's just look at a different sector and see how the diligence effect applies to that. So we can go to the next slide and see consumer staples, which was one of the two worst performing sectors in 2023. So we can see how the diligence effect applies to it. And as you can see, it doesn't necessarily produce like a negative return. That only applies here for the low risk and dynamically allocated strategies, which produce a negative return, but the other strategy produced a positive return. And in general, when looking at many other sectors, I noticed that there to some degree wasn't a consistency as to like which strategy would go up and down. Although it's rare, I saw the lower strategy actually being the most profitable at some in some sectors. So I guess it depends. But one common pattern I saw was that if the sector was well performing that year, you got a profit from the diligence effect. And if the sector was poorly performing, you got a negative profit. So in this case, like unlike the tech stocks, you went from 900 to below 900 for both the green and red strategies. So this tells us that we should be wary how we're using the diligence effect. Next slide. So if you look at strong and weak sectors, we can see that there's a positive correlation between diligence and returns for a strong sector like tech, and for consumer staples, there's a negative correlation between diligence and returns. So does investing more frequently give us more returns? Well, the answer is it depends. For strong sectors, it's more likely that it'll give us a profit, but for weak sectors, we must be careful. Next slide. So what are our next steps? As I said, there were limitations to the data that this study produced. And there's a lot more information we can draw from this. For example, we can find trends between markets. I noticed that for certain sectors, there seemed to be an ideal number, which was around like 100 less than the maximum number of times you could reinvest. So that'll probably need to be looked into more. I can also compare it to the overall market and overall sector. So for tech sector, I can look to how the sector performed and run an analysis on the full sector itself instead of just picking stocks. And I can also look at the overall whole S&P 500 and see how my data compares. And most importantly, runtime. So to get super detailed graphs with a lot of data points, it takes a huge runtime if we're working from 2014 to 2023 data. That's why this analysis only got 2023's data. So if I can improve runtime, I can get a better result that is hopefully more insightful. And next, we'll be moving on to market prediction. Sharvil?
Okay, hello everyone. So I represent the market prediction group, and the main goal of this group is to find ways to predict the market, and use this information to influence our stock investment choices and hopefully get the highest return possible. And next slide, please. In order to utilize predictions, first we need to have a sort of stock investment playground that we can easily mass produce strategies and test our code on them. So that's exactly what we did. By instead of having just 10 stocks, we have 2 to the 10 combinations of stocks. For example, one combination might be Tesla, Nvidia, and Apple. The combination could be all of them. And then there's even one combination with none of them. This allows us to mass produce data points so that we can make stronger analysis and find correlations more easily. Next slide, please. Now, what is in a prediction? When people talk about prediction power, they generally mean the ability of one data set to either predict future values in the same data set or in a different data set. Now, some examples for finance could be using previous stock data to predict future stock data, or even world events and even public opinion. Now, the reason why we want to be able to forecast stocks is that by knowing what markets will go up and down, we can know what to invest in order to get the highest return. Next slide, please. So, of course, we cannot simply step right into making a prediction algorithm. That would be very difficult. So in order to make a prediction algorithm, we decide to follow a three-step plan. First, we would simulate what would happen if we could perfectly predict the stock market using previous data from 2023. Then we would make more simple mathematical predictions using simple algorithms such as a moving average or a line of best fit, also known as linear regression. And that's where we are going forward. And we've already completed the first step. Finally, our goal is to use advanced data science concepts, such as machine learning algorithms, such as a neural network, to predict stock prices in the future. Next slide, please. Wait, so the question for the perfect prediction algorithm is, given perfectly accurate predictions, how do we get the highest return? And this answer is quite obvious. We simply invest in whatever will do the best in the next day. And one example is with just NVIDIA, the return for our basic strategy, and as a reminder, that was to invest our money at the start and then to not touch it. The return was 245%, which is quite high. However, since with this strategy, we can pull our money out right before the stock is supposed to drop, then we can get a much higher return, which was 1,235. Next slide, please. Now, our next example actually did worse than the first example with the basic strategy. However, since we can switch onto whatever will do the best in the next day, our effect slowly snowballed into a much higher return. And on the next slide, we can see this effect take hold. Here we have the returns graphed by the number of stocks used to create the strategy. And as a highlight, our highest stock strategy had a return of just over 60,000%. This, of course, is not achievable in real life. However, we can try to replicate this effect. And even if we get 1% of the capability, that is still a very impressive result. Now, as we can see, as we add more stocks, the average return is between all the stocks in one category follows this exponential relationship. One thing to note here is adding additional stocks to a strategy will never reduce the return, because if that stock simply doesn't do well, we simply just don't pick it. However, more stocks could be detrimental with actual prediction algorithm. Next slide, please. Here we see this exponential relationship, however, in a different form. This is grasped by risk versus the return. And we can also see some very interesting clusters due to some of these mass-produced strategies having similar stocks in them. I mean, similar combinations of stocks. Next slide, please. Now, the three key main takeaways from this data is one, diversity is essential. Since we gain our return by switching to the most applicable stock that will have the highest return in the next day, having more and more stocks will have more options to do this, which will generate higher returns. However, in the future, when we switch to actual prediction algorithms, it might be better to have less and lower volatility stocks, so that since it's more predictable, we'll have an easier time predicting it, and therefore it can be more safe. However, for these perfect prediction algorithms that use past data, which cannot be achievable in real life, choosing very volatile stocks is, in comparison, a better choice than the less volatile stocks that we might want for a real prediction algorithm. Then finally, risk becomes more abstract with prediction algorithms, since rather than being a quantifiable number, our risk is more of how much we trust our algorithm. Okay, next slide, please. Okay, before I move on to our next group, some future plans would be to um, analyze what other data sources we can use for predictions and actually make a prediction algorithm instead of using past data. Okay, now on to our sentiment analysis group, which will talk about one of these possible prediction strategies. Next slide, please.
So with our goal of finding the optimal trading strategy and finding a way to predict stock prices, we decided to explore the use of sentiment analysis on social media data. Next slide. So sentiment analysis is the process of using AI to extract emotion or sentiment from text. And we decided to use this approach to analyze social media data to figure out what the public's belief was about a stock's price. And when the public believes a stock's price will go up, the stock's price usually goes up because more people will invest in that stock, hoping to make profit. And the opposite happens when people believe the price will go down. Next slide, please. So we used 2 million Reddit comments from the subreddit r/Wall Street Bets, and this data came from a torrent, which is a peer-to-peer method to download data with comments from the top 40K subreddits. We took comments only from the r/Wall Street Bets subreddit that referenced the 10 stocks that we were studying. This data contained the date, content, and number of upvotes for each comment. Next slide, please. To extract the sentiment from our social media data, we use two approaches: LLMs like ChatGPT and existing sentiment analysis models. Next slide. To process the data using ChatGPT, we fed each comment to ChatGPT through the API with a custom prompt that asked the model to extract the commenter's sentiment and respond with up, down, or neutral for each stock mentioned in the comment, indicating whether the commenter believes the stock would go up, down, or stay the same. One of the advantages of using ChatGPT was that it was able to analyze multiple stocks in the same comment, even when the commenter had different beliefs for the stocks mentioned. It was also good at performing logical reasoning and analyzing the comment when it required logical reasoning. One of the disadvantages was that ChatGPT was unable to handle large volumes of data. This was because it was very expensive, with 4 cents per 100 comments being the cost of the API, and it taking about 90 seconds to process these. Next slide, please.
Another sentiment model that we decided to test out was BERTweet. BERTweet is a large pre-trained sentiment analysis model, which is built off over 800 million English tweets from 2012 to 2020. So the advantage of BERTweet is that it was trained off of a large data set that's relatively social media based. However, one disadvantage is that it was not trained specifically on Reddit or stock comments. And so as for the classification for BERTweet, when BERTweet inputs any sort of comment, like a Reddit comment, it outputs a measurement from 0 to 1, which represents the sentiment of the comment, with 0 meaning that the comment was very negative and 1 meaning the comment was very positive. However, some disadvantages to this is that it does take a long processing time due to how large the model is, and it can only give one measurement. So even if a comment is talking about multiple stocks and maybe talking positively about some stocks and talking negatively about another, BERTweet can still only give one measurement, which is something ChatGPT is better at. Next slide, please. And so we wanted to know whether ChatGPT or BERTweet was better at extracting sentiment. Next slide, please. And so in order to test this out, what we did is that we took 200 random comments from the entire 2 million dataset, and we had human researchers manually label what their sentiment actually is. And then we ran the ChatGPT and BERTweet models on both of them. And so we tested out the accuracy for both of them by generating the box plot on the right. And so based on the box plot, you can see that both models show decent sentiment prediction. For example, for the when the stock sentiment was actually negative, both Bertweet and ChatGPT put it as relatively negative. But what we noticed was that ChatGPT had a tendency to predict more positively, even for actually negative comments. For example, when the comment was actually negative, the 75th percentile for ChatGPT was around 0.5 from a 0 to 1 scale. And we saw that Bertweet showed a more smooth correlation as the human labels went from negative to positive, and as a result, we chose it as our main sentiment model. Next slide, please. And so what we wanted to see was that if there was any correlation between the actual stock change and the change in the sentiment from r/Wall Street Bets. So what we did is that for each data point represents one stock from a 1 month time period from 2018 to 2020. So for each data point, the X value represents the stock value's percentage change from a given month to a next month. And the Y value for each stock represents, for that stock, the average sentiment percentage change from that same time period. And so when we use linear regression on this graph, we notice that the p-value was less than 0.05, which indicates statistical significance. And the r-squared value was 0.33, which indicates a moderate positive correlation between the stock percentage change in a 1 month period and the sentiment percentage change in the 1 month period. And this gives us sort of promising results that we can use this for prediction because there is a correlation between the stock change and the sentiment change. Next slide, please.
So at this point, you might be wondering, we've talked a lot about the sentiment models. What exactly is this data that we're looking at? Well, this is a sneak peek of our database. It's taken sample comments from that Reddit thread, and these are the Bertweet and ChatGPT rankings of it. We also had human labeling and tested whether Bertweet and ChatGPT would match with it or not. And this is important because human labeling is our way to measure the accuracy of these models, because these are humans reading these things and figuring out whether they're going to invest or not, and therefore making the stock market go up and down based on that. And so we found that Bertweet had an 85% accuracy and ChatGPT had an 80% accuracy. But what causes the inaccuracies in the database? Well, there are a couple of factors going on. One of them is, again, the lack of good data. We got comments in our database like the one seen on the left. If you look at this, you have no clue whether the writer is even talking about investing in Tesla or whether the stock market will go up or down as a result of this. As you can see, Bertweet gave it a lower score and ChatGPT said the market was going to go up. But a human researcher would say, look, this is completely unrelated. We don't need to look at it. Another reason why the accuracy was low has to do with the English language as a whole. When you have sentiments for things, it can actually have a different meaning behind the scenes than what the sentiments actually are. And while the models can identify it sometimes, we also got quotes like the one on the right, which Bertweet gave it a low score and ChatGPT gave it a neutral score. Whereas if you were to actually look at it, you would say that, look, Tesla's about to go up. It's about to cause insane lightning storms, so to speak. So I want to invest now. So as part of this, one thing we want to do when we continue improving on this project is potentially manipulate our prompt engineering to ChatGPT to have it give better results, focus on fine-tuning the Bertweet model, and even filter and pre-process some of our database to ensure that we're getting comments that help us in investing in the stock market. As a group, we plan to finish and continue fine-tuning all of our projects and hopefully integrate them with each other to create more and more tools that will eventually take us to that final Treasure Island goal of a very high return with the lowest risk possible. And we hope to continue researching and making this into projects that we can share with people so that they know more about investing in the stock market, which is often unpredictable. So thank you so much for listening and for your time, and we're open to any questions.